The US dollar is the world's reserve currency. It's the unit of account for global trade, it's the benchmark for international lending, and it's the safe haven of choice when global uncertainty rises. When the dollar strengthens, it doesn't just affect the US economy. Its influence extends to every country that holds dollar-denominated debt, every economy that relies on dollar-priced commodities, and every investor holding assets in countries whose currencies are moving in the opposite direction. This video explains exactly how a strong dollar plays out across global markets, which currencies and economies are the most vulnerable, which are the most resilient, and how to position when the dollar strength becomes the dominant market theme. The dollar strengthens through two primary mechanisms: interest rate differentials and flight to safety. When U.S. interest rates are relatively high compared to other economies, capital is attracted to dollar-denominated assets to capture the higher yield. Investors sell other currency to buy dollars, and that pushes the dollar's value up. This was the dominant driver of the dollar strength in 2022 and 2023, when the Fed was raising rates aggressively while other central banks lagged. Geopolitical stress events produce dollar rallies through a different mechanism: fear. When there is genuine uncertainty in the global system, financial crisis, geopolitical conflicts, sudden growth scares, the instinct of institutional investors globally is to move toward dollars as a safety measure. The dollar is the most liquid, the most widely accepted asset in the world, and in a crisis, liquidity is everything. For traders, identifying which mechanism is driving dollar strength matters enormously, because the two mechanisms have different durations and different impacts on specific asset classes. One of the most direct and damaging ways a strong dollar affects emerging markets is through dollar-denominated debt. Many emerging market governments, corporations, and financial institutions borrowed in US dollars when the dollar was weak and the global rates were low. Now, when the dollar strengthens, the cost of servicing that debt increases in local currency terms, even if the interest rate itself hasn't changed. Consider a concrete example. A country that borrowed $1 billion and must pay $50 million per year in interest faces a very different burden when the dollar is strong versus weak. If its local currency has depreciated 30%, it needs 30% more local currency to service the same dollar debt. That's fiscal stress that affects government budgets, credit ratings, and economic growth. This mechanism is one of the key reasons why Fed rate decisions have such a profound impact on economies that have no direct relationship with the United States. The dollar is so embedded in global finance that every American monetary policy is effectively global monetary policy. Not all emerging markets are equally exposed to dollar strength. Understanding the distinction is where the analytical edge lies. The most vulnerable economies share a combination of factors: large dollar-denominated external debt, dependency on commodity exports priced in dollars, limited foreign exchange reserves, and shallow domestic capital markets. Turkey, Argentina, Pakistan, Egypt, several sub-Saharan African economies have historically shown the most vulnerability to dollar strength episodes. The most resilient emerging markets are those with strong current account surpluses, with large foreign exchange reserves, low external dollar debt, and diversified trade relationships. Singapore, South Korea, Taiwan, and increasingly India have shown greater resilience. China, despite its scale, is somewhat insulated by its capital controls and the size of its domestic market. For traders, identifying where each economy sits on this vulnerability spectrum before a dollar strengthening cycle begins is more valuable than reacting after the stress is already visible in the currency moves. The relationship between the dollar and the commodity currencies deserves specific attention because it creates some of the most liquid and tradable correlations in the Forex market. The Australian dollar, the Canadian dollar, the New Zealand dollar, the Norwegian krone. These are all closely tied to commodity prices. Commodities are priced in dollars globally, and when the dollar strengthens, those commodities tend to fall in dollar terms, and those commodity exporting currencies tend to weaken simultaneously. This creates a double pressure. A strong dollar means weaker commodity prices, which means weaker revenue for the exporting economy, which means weaker currency, which means further downward pressure on the currency as capital reassesses the economic outlook. For traders looking to express a dollar strength view, short positions in commodity currencies are often a more liquid and lower volatility way to do so than direct dollar positions. because they combine the dollar differential with the commodity demand channel. The dollar is not just America's currency, it's the gravitational center of the global financial system, and its movements affect every other currency, every commodity price, and the financial stability of dozens of economies. Understanding dollar dynamics, which mechanism is driving it, which economies are the most vulnerable, which currency pairs are efficiently express a given dollar view, is not optional for anyone trading in global markets. It is not optional. I'm going to repeat that. When the dollar is the dominant theme, everything else follows. Make sure you understand which direction it's pointing before you make any major position in an asset class. What aspect of dollar dynamics would you like us to go deeper on? Please let us know. Leave it in the comments below. I will see you in the next video.